Hello, ladies and gentlemen. As usual, we start our review of the week with the 10-year note in the States, and as predicted, we are basically between the 275 and the 3% area. The continuation of the bullishness in Europe is weighing on US yields, but we really don't think that we go beyond 275. There is absolutely no reason to think that the Fed is not going to hike again, at least once, but most probably twice this year, and therefore flatten the yield curve even further. It is unlikely that we will be out of this trading range between 275 and 3, in which we have been for the past several weeks, as we have forecast. If we then look at the 20 to 30 year note, the TLT, we are coming into very, very strong resistance between 124 and 125. It would take quite a feat, it would take quite a reason i.e. a very wild and hot trade war for us to break through the 125 area. So in the next percent or so, we will turn sellers of TLT, looking for a move back down towards 116, 117. But the news of the week came in equities, and you can see this trend line which has held the market all the way since the topping pattern of several couple of weeks ago has been busted to the upside. The market will now probably retrace a little bit down towards 250, but the chances are that over the course of the next week or so we revisit the highs in the 2780s and probably even higher. This is a 10-minute chart. If we look at a weekly chart, this is much more instructive. Let's enlarge it. The market has held extremely well along this moving average, which the market has traded every week since we've had the correction. This support, which now comes in around 2705 probably, or 2707 next week, held. We've closed above all these moving averages, which were resistance. They are all positively sloping. It would not surprise at all to see a low somewhere around 2745 or so next week, with a high around the 2790. But if we break that, we will go and test the top of this Bollinger Band, which is all the way up to 28 to 22, and have the best performance we've had for a very, very long time. The breadth is very positive. There is very little reason not to buy on a dip 2750 or 2740 calls for the next couple of weeks, looking for a trade all the way up into the 2800s. The daily chart is supportive as well. You can see here how we are about to turn on the MACD, giving it a nice push higher. We suspect around this kind of level, 2805, would be very nice over the course of the next week. 1 or 2 days of hesitation, then a push up towards 2805 would be excellent. We have passed the test at 2700, and I see no reason why over the next few days we shouldn't trade up to 2800. Well, what is going to push the SPX up to those levels? Well, it's quite simple. We have got leadership again from the tech. This is the Nasdaq. The Nasdaq can test the all-time highs sometime next week, most probably around 73.66. It would not be surprising at all if over the next couple of days we have a positive trend here in the stochastics around 73.66, and probably trade this kind of 7400, 7450 area before retracing back down. Very little that we can see that is bearish at the moment in the Nasdaq. What is going to push ES up towards 2800? Well, this is XLF, which is about 20-25% of the index. You can see how the 200-day moving average is still positively sloping. It would not be a surprise if over the course of the next few days we went up here and tested this kind of level around 2750, where we were not a week ago. This still wouldn't be a very pretty picture, but it's, you know, it's nearly 3% from the level that we closed today. So if we have a move of that magnitude, that coupled with the strength in tech, that should certainly do it. And here is XLY, consumer discretionary, which seems to be doing very well. It's getting, you can see these blue blobs. That means the market tried for a new low over the previous day, failed, and closed above it. This is a pattern which certainly goes and retests the gap that we have here at around 111. If we have a better look here, this gap will certainly get filled, 111.30. And that might also give a bit of an impetus to ES, certainly take it very close towards 2800. This is VTI, which is the Vanguard Total Stock Index. As you can see, it's made some significant lows off these moving averages and Bollinger Bands. The market's held beautifully. It's closed above everything that we track and we think is important. This kind of gap fill up here towards 145. Don't forget we closed around 142.80. That is a good 3% move. We should be able to do that at some stage over the course of the next couple of weeks. That would indicate ES certainly above the 2800 level. So everything is lining up positive for the next few days, which would coincide with basically, in fundamental speak, very little action from the tariffs, a calming down of the situation, and the market breathing a sigh of relief and rallying into the next level of resistance, which will be the Bollinger Band and the close of that gap all the way up to 145. Nice move, worth having, long of call spreads. As I tweeted to you today, VIX has potentially a long way to fall. It could certainly fall down to 1170, but with the Bollinger Bands the way they are, they could make a new low. Again, this justifies our view that it's quite possible that we get a lower low in VIX and therefore a higher high in the S&Ps, which would certainly take it to a 2800 plus handle. So everything is falling into place. If you're not long here, you are unlikely to get a better constellation over the next few days. And this is front month futures in the VXN. You can see how much room it has to fall. This is where the market was trading when it was up at 27.80, 90. We could easily exceed that. Everything basically is pointing towards 2800 at some stage over the next week or so. Even DXY is actually helping the S&Ps. 93.63 seems to be the next level it's likely to trade over the course of the next few days. That's another 0.5% or so. But certainly it is no longer a headwind in the face of the S&Ps. Therefore, we are likely, with all these bearish formations on the technicals, to have several more days of dollar weakness, and if that happens, we are quite sure that the market will, in equities, will keep on going higher. The one market which could outperform on the upside is actually EEM. If we have no more trade tensions, it would not be surprising to see this 45.15 level retested. This is basically where we broke from. 45.15 as a retest would be very easy, 2 or 3 days work basically, and that is a long way from 43. That is almost 5%. So to get 5% out of EEM and 2 or 3% out of S&Ps is absolutely reasonable as a correlation. Once more, just to prove the bullishness currently and the tech leadership, here is XLK over XLF, and it just keeps on trucking. It basically just saying that the market is still bullish. The sectors that it wants, and all it does, it retraces slightly when those sectors take a breather. So nothing has really changed in this market. XLK is the market. When XLK takes leadership, the market goes up. When it rests, the market goes down, and then moves sideways until XLK retakes leadership. This is just a pattern which is unlikely to stop. Certainly not this summer. There is no reason, fundamental reason that we can see, and therefore the market is just not ready to break down. Buying calls and call spreads is definitely the way to play it. Our very early indicator, which is SOX over FXY, again managed to hold the 200-day moving average. I mean, this is a wonderful indicator. Only if you see a really protracted break with this 200-day moving average turning over, you will know that the market is no longer bullish. As it is, it's bullish. It continues higher. There is absolutely no reason to short the market. Still, call spreads, as I've said, the way to go. Just to show that we're not only bullish of tech, we're actually turning very constructive on the Dow, and this could be a double touch of this moving average, which could actually give us 25,500 over the course of the next couple of weeks, because this is a weekly chart. That would be a very constructive development, because that would be as high as the market has been over the course of the correction, and after that a few weeks sideways and probably new all-time highs. So even the Dow is saying, I'm not bearish, I could be going quite a bit higher from here, buy some call spreads on the Dow. And finally, I'd like to show you stocks, because this has been very, very resilient and actually has led the US market slightly higher. It's led it by a day, which is normal because the S&Ps just basically did nothing ahead of non-farm payroll. This market is likely next week to touch this 3,520 level, which is a good 2.5% higher than it closed today. Again, this is another confirmation that we are likely to have a period of 1 or 2 weeks of strength in equities as a breather, from the pessimism about potential consequences of tariffs. Would not be surprised at all to see the market very quickly spike up this 3,520 level. And so to the biases. Nothing changes for the 5 and 10 years. 3 to 270, 275 in 10 years is about as good as you're going to get. Bunds and Bobble doing absolutely nothing. Tensions are calming down a little bit in Europe, but still no movement whatsoever there. People are still holding on to safety and not doing very much. Here we are looking for 28.10 again. Buy the dip, elevated tail risk in present, both to the upside and downside. We said last week it's now the upside, and therefore people will be surprised by how far up it goes. I think very few people will be looking for 28.10, 28.20 next week, and that's why the market is likely to go up there and surprise them. NQ, we think it's going to test all-time highs. It's been resolved to the upside, and it's taken leadership again. It's unlikely not to trade at least very close to all-time highs before it stops. Nothing much else to say. XLF, as we said, we think now it goes up to at least 2,700, which will potentially boost the S&Ps even further. and volatility indicates that there's plenty of room for it to go down and therefore support the rise in XPX. We are now looking for 93.20 as a level here in the dollar, and that will be incredibly important because if it goes through, it's definitely going towards 92.05. But that again, as we said, is supportive of US equities. Very little reason to be short of them, and call spreads are the way to go. Thank you very much indeed, and speak to you next week.